Making the right investment at the wrong time. An asset can be fundamentally strong. The thesis can be correct. The long-term outcome can even validate the analysis. And yet, if the timing is wrong, the psychological experience can be brutal. Here's a research-based breakdown of what happens when someone makes the right investment, but at the wrong time. 1. Being early feels like being wrong. Markets are noisy in the short term. Even strong assets can decline significantly before recovering. Behavioral economist Daniel Kahneman showed that humans evaluate outcomes relative to reference points, prospect theory. So if you buy and the price drops 30%, your thesis may still be correct. The fundamentals may still be intact. The long-term case may still hold. But psychologically, the loss dominates. Being early feels identical to being wrong. 2. Loss aversion amplifies the pain. Prospect theory, developed by Daniel Kahneman and Amos Tversky, shows that losses hurt roughly twice as much as equivalent gains feel good. So even if the asset later doubles, the thesis proves accurate. The interim drawdown creates intense stress. The investor experiences self-doubt, rumination, regret, anxiety. Correctness does not eliminate emotional cost. 3. Time horizon mismatch. Often the investment thesis is long-term, but the investor's emotional tolerance is short-term. This mismatch creates tension. If someone intellectually commits to 5 to 10 years, but emotionally reacts to 3-month volatility, the investment becomes psychologically unstable. The asset didn't fail. The emotional runway did. 4. Social pressure intensifies doubt. When an investment drops after purchase, others question the decision. Social media amplifies negative narratives. Contrarian positions feel isolating. Research on social conformity shows that dissenting from the majority increases stress. Even if the thesis is correct, social disapproval magnifies uncertainty. 5. Opportunity cost regret. While holding the declining, right, investment, other assets may rise. This triggers upward counterfactual thinking. I could have bought that instead. Now the pain is doubled. Actual drawdown. Imagined alternative gain. Even if the original thesis eventually works, the interim comparison damages conviction. 6. The overconfidence correction. If someone enters early based on strong conviction, early losses can swing them from overconfidence to excessive doubt. Research on overconfidence in trading by Brad Barber and Terence O'Dean shows that investors often misjudge timing ability. When timing fails, identity takes a hit. The question shifts from, is the thesis intact? To, am I actually competent? 7. The survival test. Making the right investment at the wrong time becomes a test of psychological endurance. Because long-term investing is not only about being correct, choosing quality. It is about surviving volatility without abandoning the thesis. Many correct investments fail for investors, not because the idea was wrong, but because the discomfort window was too long. Key distinction. Wrong investment. Thesis broken. Fundamentals deteriorate. Long-term case collapses. Right investment, wrong time. Thesis intact. Fundamentals stable. Emotional pressure intense. One requires exiting. The other requires resilience. The core insight. In complex systems like markets, being early often looks identical to being wrong. The market does not validate correctness immediately. It tests conviction first. And psychologically, that test can feel indistinguishable from failure.